Being smart doesn't usually work in the stock market. In this video, I'll explain why. So having traded for over 30 years and having taught people how to trade for over 20, one of the things that has stood out is that smart people often do not do well in the stock market. And not because they have bad intentions or because they are not diligent in how they research. It's actually because of those things that we can see a lot of problems in people that really apply good rational thinking. One of the first problems is that most people approach the market looking at publicly available information. So they read news releases, they read research reports, perhaps they watch mainstream media, and in doing so, they are gathering information about companies that is widely available, that everyone knows. Here's the thing about the stock market. It does not move in the future based on what is already known. In the future, it's going to move on what people will learn in the future. If you are making decisions based on publicly available information, you are destined to fail because that information is already priced in. If a company announces that they found gold last week, well, the stock is going to have already gone up to reflect that information. And so to make a decision based on what has already happened in the past and what has already been priced into the market is going to lead you to be chasing a stock rather than leading the market. So one of the key things is to not use public information to make decisions. If you're going to use information at all, you have to have better information than most people have. Now we can call that inside information, but it's not always that way. Some people are good at gathering information because they have expertise in a certain area. Others will simply uncover things that are not widely known by doing really in-depth research. But for the most part, most people, myself included, really don't have access to the kind of information across a wide range of stocks to be able to predict what will happen in the future. Some people do, most of us don't, so we have to do something else, which I'll get to later in this video. All right, next up, let's take a look at reason number 2. Investors don't think that they're wrong. Smart investors don't think that they're wrong because they will have spent a considerable amount of time gathering information, researching the company's story, and they get married to the story. They fall in love with the company. And then when new information that comes into the market that is negative, but maybe not widely known, when that new information comes in, the stock will start to drop. But they have so much conviction in the research that they have done that they don't listen to the message of the market. If we look at a chart of Facebook as an example, Facebook was doing really well in 2021. It was in a nice upward trend. And if you bought it here, you need to know where your exit door is. Where will the market prove you wrong? Well, that's always, in my approach to the market, always at the point where the market stopped going down and started going up before you buy. So in the case of this buy signal, not that it was a great buy signal, but if you use that as your buy point, your support is right here. If the stock breaks down through that support, then the market is telling you that you're wrong. Because what was happening here? Investors were pushing the stock down, and then the buyers came in and said, we have some information that justifies this stock being at a higher price, and if it goes up, then whatever information caused that turn sets a barrier. And if price then falls back below that floor, it implies that there is some new and negative information to justify people selling. And anytime you get floors in the price, you are essentially putting your line in the sand for where there should be an exit signal. So we can use that with trend lines. Here's an upward trend line. The upward trend line was broken there. Or we can do that with horizontal lines of support like here. When those lines of support are broken, there's a sell signal. And we can see it over and over again. Here's a strong area of support that was established a couple of times. And when you broke down through support, you had a signal to sell. Who was selling there? People that knew that there were problems with this stock. When the public learned of those problems, which is this big gap down here, well, that's when it's too late. That's when the news came out, the negative information came out. By that time, you're a dinosaur. You need to sell when the market tells you to sell, because the people with the best information are selling first. They're the ones taking the stock below those floor prices. And then when the news comes out, then everybody else sells, and by that time it's too late. All right, let's move on to reason number 3. Smart people tend to focus too much on the details. So, what do I mean by this? Unfortunately, when you look really deep into a company, you sort of lose sight of what's important. The market tends to move on one or two important things at any one time. So in the overall stock market, the one or two things could be a war in Ukraine and potential for inflation and rising interest rates. Okay, those are the two things that the market might be completely focused on at that time. Now, you could dig into the market and say, oh, it really matters that the President of the United States has this new policy and it's going to create jobs and that's good for the stock market and blah, blah, blah. Well, if the market doesn't care about that, then it's not going to affect where prices move. So you always have to think about what are the two most important factors. And you can do that with the stock, or you can do that with the overall market. You can do that with the sector. These are the things that are going to drive most of the price action. The details don't really matter. And I've taught a lot of traders who maybe come from engineering or accounting backgrounds. They pay attention to detail. And what I have to help them with is to overcome this focus on the detail, which are very important in the things that they do. Obviously, if you hire an accountant or an engineer, you want them to pay attention to detail. But in trading and investing, you have to focus more on the big picture items. Those are the things that are going to drive price the most important. All right, reason number 4 is people just don't trust the market. The market gives us a message. Every available bit of information is priced into the stock market almost immediately. And it's the things that we don't know that are priced in first. You know, I'm going to assume that you, just like I, don't have access to inside information on lots of companies, and therefore we really don't have a benefit to using information. That's what we started this video with. However, within every company, within every sector, there are people that know more than most of us. And the people that know more have an advantage. They can use that information advantage to extract good profit from the market on that particular stock because they have better information. Well, if you know a company is going to announce good earnings because you really have a great insight in that sector, or maybe you work for that company, or you have a friend that works for that company, or whatever, you have access to better information. You know that earnings that are going to be announced in a week are going to be better than the market expects. Well, what do? You're going to go out and buy the stock. And in doing so, you leave footprints. Because every time you make a trade, it is tracked in the volume and price action of the stock. Now, if you or I do that, it's not going to matter a whole lot. We're not going to move the market. But if a large investment fund, a hedge fund, an institutional investor, has better information, they've done the research to uncover information that is not widely known. If they then go act in the market and they buy 1 million shares of a stock and they accumulate that stock over the course of a number of days, they are leaving much bigger footprints, and they create the market activity that we can track through a stock chart or through algorithms that track abnormal behavior. That's what we do at Stockscores, is we're looking for abnormal activity in the price and volume of a stock because it tells us that something is going on, that someone has better information than others, and with that information, they are acting in the market and they're leaving footprints. So what you want to do is trust the message of the market. When a stock starts behaving abnormally, starts going up more than it should, trading more volume than it should, there's probably a reason. And just because you don't read about the reason in the Wall Street Journal doesn't mean it's not there. It will be in the Wall Street Journal in the future. The market moves in anticipation of news, not always in reaction to news. I hope that's been helpful. Why smart people fail in the market. It's not really that being smart is a detriment. You just have to understand how the market works, how information is spread to investors, and the fact that the information spread is rarely fair. There are always going to be some people that get better information than others, and you have to follow the message of the market to take advantage of that. Hope you've enjoyed it. If so, click on the like button, subscribe to the channel, leave me a comment. What do you think has been your biggest detriment in trading? Trade well.